Mike Bessel, you are Managing Director, European Investment Strategist at Invesco Real Estate. Thank you for joining us on BITV.
Thank you very much for having me, and Happy New Year to everybody.
Yes, thank you very much. Let's talk about the new year. In a forward-looking note published last week by Invesco, you argued that, and I quote, "While our European base case is for a short period of mild recession in key European real estate markets, we believe that real estate returns will continue to exhibit increasing asset-specific divergence with markets and sectors." What trends leads you to this optimism about real estate markets at a time when, let's be honest, they have been slowed by macroeconomic stress?
So thank you, Luc Etienne, and I fully understand why that may not seem a logical conclusion in a time of slowdown. What we're really trying to say here is that what we are seeing already, what we expect to continue to see, is a further bifurcation, a greater polarization within sectors and within markets between the best assets and the worst. And that is coming through both in terms of occupier demand, so the ability to pay the rent, but also investor demand in terms of supporting cap rates and funding flow. And there's a number of drivers of this. Changing patterns of utilization is one of them. With offices would be a key example where changing patterns of behavior through the COVID pandemic and as we come back to work is shifting how that is thought about, but also the increasing focus on ESG and sustainability. So we've seen a lot of this pattern in retail for a while. Retailers have been very specific where they want to be. That is not a cost point. They want to be in the best retail locations. They want to avoid the weaker retail locations, and some of those you almost can't give the space away. We're starting really now post-COVID to see that in offices. We're seeing a changing pattern of demand between the very best of the sorts of office you're sitting in, a very vibrant environment, well located, versus weaker locations, older assets, less flexible, less sustainable. So what we're saying is really within our markets, that pattern of behavior is going to continue, and that is going to effectively, that is going to drive greater asset-specific selectivity. And in terms of the macro pressures, what this really brings us back to is, the supply of real estate, the ability to construct, the ability to adapt assets to future use is impacted by rising costs. The inflation that is plaguing all of our lives is very true in construction cost inflation. The labor limitations from labor pressures in all markets are definitely there. And also at a time of economic uncertainty, a lot of landlords are less willing to develop. So our relative optimism for those best-in-class assets comes from the fact that the fundamental demand for many types of real estate will remain even in an economic slowdown while the supply remains limited. But what we're very clearly trying to say here is that there will be relative winners. We think those will perform attractively at an overall asset allocation, and our job is to identify those relative winners.
Okay, and talking about differentiation between markets, you mentioned asset classes. I'd like to ask you about the same trend, maybe from a geographic point of view. Could these trends, these engaging trends, apply to some markets more than others? How might European real estate markets compare to their American and APAC counterparts? I know that Invesco is active worldwide. How do you see the subject from a geographic point of view?
Absolutely, you're spot on. Those structural trends that are driving that real estate demand and the returns are very clearly playing out differently in different markets. On the capital markets side, as all of your viewers will be well aware, we're seeing a very different interest rate response between key markets. For example, with the Fed or the UK Central Bank leading the charge on raising rates against inflation, the ECB has been slower to respond, while Japan has continued to see low inflation and maintained an accommodative monetary policy. So what that does from a investor demand profile is this flows through into funding costs for real estate. It flows through to the cap rates against which real estate is valued. And we're clearly seeing differences in the regions in that relative repricing. But also on the occupier side, those structural trends are playing out differently. One of the key thematic drivers of a lot of real estate demand is urbanization, and that is playing very differently in different markets. You know, we look at Asia, and a number of cities continue to have very strong urbanization forecasts. But actually, the same is true whether you look at Eurostat numbers, Oxford Economic numbers, the same is true for European cities. A growth of population, a change in household type within those markets is continuing to put pressure on that need for the built environment to house people, to provide space for them to work, to provide space for them to live and play. So all of that is coming through, but it is playing out differently in each market. I touched earlier on the impact of hybrid working post-COVID, and that's definitely a place where we're seeing this play through very differently in the three regions. Asia and Europe continue to see very, very good demand for well-located, high-quality, flexible offices, whereas in the US, there's a greater relative drop in demand, and there's also higher levels of vacancy. So unlike Europe and Asia, we're seeing a downward pressure on rents in the US. And again, it comes back to those structural pressures, less of an urbanization pressure, longer commutes, changing patterns, larger household units. So people in the US have more space to have a office set up at home. A number of these factors play into that relative demand, and we need to understand that in order to pick those winners and losers, but they are regionally nuanced, to answer your question.
Great. And maybe in light of these convictions, which markets, asset classes could attract Invesco's investment focus over the next year in Europe, more specifically?
So we continue to have our conviction themes focused on both markets and sectors where we see long-term structural demand drivers and relatively limited supply. That is what will enable us to continue to drive positive cash flow growth. We're also very clearly seeing ESG and improving sustainability as a key trend here. You know, the energy efficiency of buildings is very well trialed, but also increasing regulatory requirements. Buildings have to meet certain standards in order to be able to be leased. There is a long tail there of assets that will need to be repositioned for future use. So these are structural trends that we see persisting even through a mild economic downturn. You know, European apartments, we remain very positive on. Europe as a whole has been underbuilding residential supply. We're watching for affordability, very well publicized in certain markets, but that is definitely a structural trend, building on that urbanization theme that we remain positive on. Similarly, combine that urbanization with the e-commerce change and urban logistics that need to provide those deliveries into stores and to consumers last minute. You know, that is space that remains in high demand. We continue to work around the grade A offices in key locations, looking to reposition assets into that. And similarly, and one that surprises a lot of people, but the patterns for global travel trends, not just from China, but elsewhere as we come out of COVID, people want to get out and explore the world. So centrally located hotels in key European cities where you've got limited supply of new stock, you know, that is an area we're very much looking to continue to invest into to play that recovery in global travel.
Great. Mike Bessel, thank you very much for sharing with us this very interesting insight. And thank you all for joining us, and see you soon on BITV.
Thank you very much.